When it comes to liquidity pools and DeFi, farming, earning an active income each and every day, you have two options between pools. You have stable pairs and you have volatile pairs. One of my members in my private community, they reached out today, which again, if you want to join, click the link in my description. But he reached out about what really is the difference between asset to asset pairs, your stablecoin pairs with an asset, or even just stable to stable pairs. Like, what is best? What is the strength and advantage of each one? What is the disadvantage? And that's the quick video I want to make here today, just so you can get a good understanding of what the benefits are and in what situation which one makes sense. Right now, this portfolio here on VFAT, it's $27,000 at a 70% APR estimate right now. This is usually much closer to 10%. This portfolio should bring me about $2,700 each and every month. Last month, it was only at about $2,500, so just shy of 10% per month, which is fantastic. That is all I am seeking from this portfolio. Now, again, he's asking, so what is the biggest difference between stablecoin pairs, asset to asset pairs? Like, what has a bigger advantage in what situation? So again, we want to understand our liquidity pools, right? We want to understand the composition. So something like ETH to USDC right here. This is an asset paired with a stablecoin. That means that your exposure to assets in this pool as price starts to move up. So if you take a look at the right-hand side here, this is my lower boundary for my range, and this is my upper boundary. As this current price moves around, my proportions of Ethereum to USDC is going to change over time. Essentially, as I start to get closer to the 4,900 mark, 4,972 specifically, I will be slowly converted into 100% USDC. So I have taken profit in that instance. The opposite is true on the way down. And it's important we understand this fundamental of liquidity pools, that I'm going to get DCA'd into Ethereum. And so if we go down below 3,800, or 3,872 to be exact, I'm going to be holding 100% Ethereum. So that is the biggest way that a volatile asset to a stable asset is going to differ, because your risk to the downside is going to be the volatile asset. If you lose your range, you're stuck holding Ethereum all the way down, which if you're someone that believes in Ethereum long-term, because you should only be doing pools and assets you believe in, then you'd be holding ETH. Nothing's going to be different than a spot position. There's no downside outside of Ethereum's risk itself. Now, the downfall of stablecoin pools here is that if 4,900 is a level much earlier than your take profit target, you have now sold into all USDC by 4,900. And you've sold along the way. So you've been selling. And it's like right now you'll see the proportion wise. Let's take a look at, I can see actual value. I have $4,200 of ETH in this pool, and I have about $6,000 of USDC. So over half of this pool's $10,000 right now is in USDC already, which right now, as the market is moving and ETH is 4,500, that might be a good thing because I have less exposure if ETH starts moving down. If you're someone that is looking at this right here and you see that Bitcoin versus the M2 money supply, you see that the market is about to go crazy because we're just printing money, then maybe you really don't want to get cashed out by 4,900. So then what are your other options? Because your option is if it goes out of range to the upside and you decide you want to rebuy Ethereum, you are literally rebuying Ethereum at 4,900 at that point. And that's where impermanent loss comes in, because now you've sold and now you're buying again at a higher price than you've already sold the asset. So what are your other options? Well, you could do an asset to asset pair. That's a different option for you. Now, it's worth noting that oftentimes, and APRs look low right now in general, that's why it's averaging 70%, when usually it's averaging about 120, maybe a little more. But the biggest difference, so stablecoin pairs, they'll usually pay quite a bit more ETH USDC because you are having more impermanent loss, you're selling out of the asset, right? But what you could do is you can come to an asset to asset pair. And let's look at either we have ETH to Brett. Let's do something like Bitcoin to AVAX, actually. This is beautiful because it's got an even higher APR and it's less risky assets. So again, we believe in our assets long-term. So, if you believe in your assets long-term and you think the M2 money supply is going insane, you think they're printing crazy, I don't know why my hand's all cute right now. You think that the money supply is being inflated and Bitcoin is going to track that. You believe in this bull market is coming. You believe your altcoins are about to boom. Well, then it probably means that you don't want to pair your assets with stablecoins because you don't want to get cashed out. So in a situation like this right here, this is AVAX paired with wrapped Bitcoin on Avalanche chain. So what this is, it's going to be very similar to the stablecoin to Ethereum pool, where at the bottom here, we're holding the more volatile asset. So in this case, AVAX. We're going to be holding the more volatile asset at the bottom, and at the top we'll be holding more Bitcoin, which means that anywhere in between, we're staying liquid, right? We're moving between the more volatile and the less volatile asset. But it's important to remember that at the bottom here, our downside, like let's say Bitcoin holds strong, the market nukes, and AVAX really underperforms. It just drops like a fucking rock. You're going to get converted into AVAX on the way down through this relationship. And then past the edge of this relationship, you're going to be holding just AVAX. So it's important, again, to remember your biggest risk in these pools, outside of getting on a sketchy site, don't use sketchy sites, it's going to be the asset you're choosing. But AVAX is not an asset I think you should be scared of. Now your upside, say you believe in AVAX through this bull market. At some point through this relationship, you're going to get cash into Bitcoin, which is one of the best assets you can hold long-term. So is your downside really that bad? You're getting cashed out into a long-term asset like Bitcoin instead of getting cashed out into USDC. And now also, where this pool, asset to asset, shines, one, it's out earning the stablecoin one right now, which is freaking awesome. Not typical. On two large cap assets like this, earning 60% is usually rough to achieve in a year, but very great opportunity right now. But the beauty is, remember this relationship, right? So there's only $2,000 in here, $2,300, right? And $1,300 of that is Bitcoin, and $1,000 of that is AVAX. I'm actually heavier in Bitcoin right now. But the beauty, if we agree that this is happening, that Bitcoin's going here, which means AVAX is going there too, if we're in agreement that that is happening, this whole pool is primed to launch. This whole pool is going to continue to move to the upside, to keep printing, whereas, for example, back to our stablecoin to ETH one, the problem with ETH USDC is that the quote asset is USDC, that's the least volatile asset, and it is not going to move. So if this bull run happens, you're going to get stopped out really fast. I mean, to be honest, a lot faster than you would want, unfortunately. But the beauty of Bitcoin to AVAX, for example, which I'm not saying choose this pool, it's just a good example, and it's two large cap assets we all understand right here. But the beauty is that these can be going up in price together proportionately. So if I'm quoting AVAX in Bitcoin, it's how many Bitcoin does it take to buy an AVAX? And it's going to be, for example, sorry, had it on the other way. If I'm pricing it in Bitcoin, how many Bitcoin does it take to buy an AVAX? And right now it takes 0.000256 Bitcoin to buy an AVAX. You know, a couple Satoshis in that bitch, essentially, right? So what's important to know is that AVAX can go up in value at the same time as Bitcoin, and they can move up proportionately. And that's where tracking correlation on something like DeFi Llama does make sense. And that's what Kyle was asking about here in this message about correlation. But it also doesn't matter that much because you're still going to get better results than something like with a stable pair right here. But you really don't want to have assets that, which if you're investing in quality assets you believe in, they're usually going to be correlated. If you have something that's very uncorrelated to the rest of the market, it's probably a weird shitcoin of some kind, where when the whole market's going up, if yours is going down, it's probably a weird coin that you're invested in, right? If Bitcoin's going up, AVAX is going up. And you can just see that from TradingView. Everything is green today, right? AVAX is up 0.6% and Bitcoin's up 1.7%. So they both moved up. That's great for the correlation. And actually, to show you AVAX's chart right here, I can price this in Bitcoin. So now I can visualize this specific pair. I'm looking at what AVAX looks like priced in Bitcoin. And I believe this is part of your question as well, like how to pick the ranges and whatnot here, Kyle. And so for Kyle or anyone watching here, you want to price your AVAX chart in Bitcoin. Bitcoin's now the quote asset. So you're tracking the relationship. So just because this is going up doesn't mean price is going up, vice versa. It just means that right during this uptrend, AVAX is outperforming Bitcoin. That could still mean that prices are moving down. It just means AVAX is moving slower than Bitcoin. However, that is very unlikely in this specific pair and relationship. During this down here, this giant downtrend all the way through April, right? This big downtrend right here, and we bought the bottom in April. Remember we talked about this in this channel? That is Bitcoin outperforming AVAX. AVAX was bleeding money in comparison to Bitcoin. So that is not good. That's the more volatile asset swinging down. So what you're trying to do in this range right here is choose the relationship between two volatile assets. You're still choosing a quote price. And it's easier to do this on volatile assets because they both move in tandem together, is what I'm trying to get at. So what makes the most sense when? Stablecoin pairs, they can pay very, very well a lot of the time. A lot of the time they pay more than the asset to asset pair. At this current moment in time, I really can't give you an attractive reason why you'd want to be in this one over the other one, because it's paying less and you'll have less appreciation. If you're in a rangy market though, where things are just going sideways, this is usually a really good option because it's going to pay more in the volatility of that area. Or people are selling their Ethereum or they're buying Ethereum with their USDC, it tends to get to be a really hot pool. The other thing, the other time this pair makes more sense is when the market is moving down. Because if you're unsure, if you're unsure if the market's going to go down or not, and we do end up going into a bear market, you are going to lose money slower in this position. Because keep in mind, the majority of this position right now is in stablecoins, only 4K in ETH, 6K in USDC. So the majority of my position is in stable. So I'm going to lose money dollar for dollar less, just like I would make money dollar for dollar less in a pool. A great example actually right here is this USDC to black, right? This thing I had 3K in, it's still down to 1,500 right now, but I would have lost so much more money on this position right here if I wasn't paired with USDC. This one's full range, so you don't have to set a range. It's just always going to be equal amounts of, see, 764 USDC to 762 black, right? So within $1 difference. What's important about that is that the market moves down on black because it has tons of sell pressure, guys. It really does. I'm going to lose money much slower than anyone who is holding just black. And I'm also making a nice APR off of it, where I'm making 12 bucks a day off $1,500, right? So I'm earning a great cash flow and I can make this money back really, really fast that I'm down. And I have the potential to have those prices appreciate again later. The downside, again, is if you're expecting a big bull run on black and you think this coin's going to double, triple in price, if you're paired with USDC, you're going to make money slower. It's going to be harder to get appreciation out of this pool because 50% of your pool is in stablecoins. So again, to switch you around, you have AVAX to black, which is going to be the same position, except instead of USDC paired with it, it's AVAX. And you can see this one's worth a little more, even though I invested the same amount. And why is that? Because, well, black got fucked in both situations. So black is down 50%. But because there was AVAX in here too, which performed strongly, I still managed to make some appreciation out of this pool, even though they're both down. But actually, they both cash flowed enough that I am still risk-free on these positions, and I hope they return to their entry price soon. So when possible, you want to use asset-to-asset pairs. The problem is sometimes to get a good APR, it's just too tight. You can't. You'd have to do something like this, right? Which you can see in a couple months it came out of range, but also it was in range for months, and that's very, very good. So it's hard to get the same APRs that you can get on stablecoins a lot of the time. And again, I don't have a great example to show because this is showing 44% when usually this is much higher, right? So if things are close, you always do want to go asset to asset unless you think the market is going to move down because the stablecoin is going to lose less money. Another great example I have was Arrow to USDC. When I first invested in this coin, it's probably like at $1.25, $1.50 a year or two ago. And Arrow was 30 cents a while back. Like I was down bad. But because I was paired with stable coins, I lost money tremendously slower. And I had 2 years of earning crazy APRs. Now it's down to like 30% right now APR, nothing insane. But I am more than risk-free off that position. That position can just do whatever it wants at this point. But when I should have been down to smithereens in my portfolio because it got nuked so hard on Arrow, I still had a good chunk of change because half of it was USDC. But the rebound we've had from that 30-cent Arrow back to $1.50 and now around $1 somewhere. Right now, let's see, it is $1.20. That rebound here, I didn't make as much as I would have made just holding spot Arrow, but I did have spot Arrow on the side in a leveraged position we can talk about another time that I do talk about in my private community quite a bit. The only other category of pool positions would be something like a stable to stable pair where you're trying to run liquidity for, let's say, USDT to USDC, for example, right? You're running two stable coins. And yeah, you might make a 14% APR. That's cool. You do need to still chart these and see, because even though they're both supposed to be pegged to $1, there's small little fluctuations. And you can see this pool width is 0.02%. So you can't really lose on these outside of DEX risk. Like you don't want to be, again, on a sketchy website. But there's places where you can make 14, 20% doing these. But you'll see if I even just do that, now I'm only earning, let's see if I double it, I'm only earning 7%, right? I can make more just lending. I can usually make more just lending on a site like Navi where USDC is earning, well, I guess it's only 8% right now. So still pretty competitive. It's just that you still can go out of range on these. So you want to be careful. Different layer twos, different blockchains, they're going to have more fluctuations than others, right? So just good to be safe. Make sure your biggest risk, again, in one of these positions is just choosing a good DEX. Black hole, obviously outperforming because it's new, but you don't want to jump on something random you've never heard of before. Like, you just don't. It's not worth it, guys, I promise. It's not worth making 14% a year and then you lose your money because you're on a bad platform. Black hole, I do have money invested in there. I think that is something that you could do. And guys, keep in mind, not all pairs are created equal, okay? Something like my ETH to bread, my ETH to Doge, right now, they're not cash flowing well, but it's also important that you track over the course of a month or even a couple weeks, because even though this says 12% right now, this thing's been doing more like 40 to 60%. So, you know, sometimes for YouTube videos, things can look really good or really bad. And right now it's just not looking too good, which, you know, if anything, that's good because it's going to make you guys less horny and degenerate and make you more just sensible, hopefully, you know, investing mode where you're thinking about consistent long-term gains, how to treat it like a business and not just like seeing all 244s, like, oh, fuck, make money, you know, because what's important to remember is, again, these black hole positions, they cash flow well, but depending on when you entered, you might be substantially down on some cash. Like these positions, I am down a little bit on cash. So I'll be looking to reinvest a future bottom. But I am also using these to just cash flow new positions, right? So both of these are down about 1,500, but I've also cash flowed out to other wallets and choices, different pools. And I've cash flowed like right here. Like this is built all off fees from these. Same with these right here. So, I mean, even though these are down 3K, there's 2,300 plus 700, it's about 3K there, 3,500. So still in profit, plus the stuff I've sent to other wallets. So, I mean, really, guys, it's just pretty damn consistent. You just want to be choosing quality assets. In a bull run, you want to be asset to asset as much as possible. Another solution you have if you do like stablecoin pairs is if you're using borrowed capital against a leveraged asset, you don't need to worry so much because you have Ethereum backing this position. And what I mean by that is my favorite strategy that I talk about quite frequently is going to be where you are lending assets and borrowing against them. So like, for example, right here, this Ethereum was worth 10K back in April. If I was running just pools with 10K, I would not be at $30,000 value right now. But I had that 10K lent out, okay? And now that 10K is tripled to $31,000, okay? It fluctuates between 30 and 33,000 depending on where ETH is at right now. And I've been using borrowed capital against assets like my Ethereum or assets like my Bitcoin or assets like my Sui or even Solana. And I'm borrowing against it, paying 5 or 6% a year to then come over here and let's say worst case, I'm making 70% a year. And I'm using that for cash flow. And so what's nice is I'm not worried if I get stopped out at 4,900 because I still got 30 grand over here that's just gonna fucking pump when ETH pumps. So I think that's very important to understand as well. And what you can do is against all your large cap assets like that, XRP, Ethereum, Bitcoin, Solana, you can borrow modest amounts to use for your cash flow activities. That way, if the market is moving down, you are able to still continue making money even in a decline. You're making money when we go sideways. And when we're going up, you are really cooking up some funds. And then don't be scared to take profit. A week or two ago, I threw another 13 grand over here in just cash and lending out for 6%. I have more cash on places like Navi earning 8%. XtraFi is another one earning probably 8% right now as well. They're earning 8.4%. I saw Jupiter Lend is earning almost 9% right now. 9% on your USDC. Guys, that's crazy. That's stock market like returns on a zero vol asset. So guys, if you have any questions like Kyle here, you can throw them in the comments below. Or if you want to work one-on-one with me, click that link in my description, book a call with me. We can work one-on-one together, get you access to my private community here, 105 members, all with access to me each and every day, teaching people how to earn $5, $10, $15,000 a month. Some people earning as much as $2,000. There's one guy that on a good APR day, $9,000 a day. So again, click that link if you want to get started working with me. And if not, like, subscribe the video for me. And YouTube says you want to watch this video. See you next time, guys.